please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Just a word on the markets. At this point in time, still very, very flat. So from morning, we haven't had too much of a move except for a slight downtick in the Nifty Bank. But otherwise, flatness prevails, which gives us a good time slot to discuss that policy announcement that came yesterday, Cabinet allowing 100% foreign direct investment under the automatic route for single brand retail. Remember, it's 100% is already allowed, but you need approval. We have got Rakesh Biyani, Joint Managing Director, Future Retail, and Abneesh Roy, Senior VP Edelweiss, with us. In a bit, we'll be joined by Mr. Suresh of Arvind as well. Rakesh, good morning, and to you first. What's the material difference of this announcement?
Good morning. I think, approval route and automatic route, of course, the approval process now doesn't require, will reduce the timeline to start business by at least about 4 to 6 months. So that is one. But I think the bigger underlying change that has been announced yesterday, which is under this route where the 30% sourcing norm, there's a significant relaxation for a period of 5 years, where instead of really sourcing for India to sell within India, incremental sourcing done for overseas would be considered towards that obligation. I think that sort of makes it easier for many companies to do business in India on a single brand route. But if you really look at the overall retail policy, and I think we've been sort of talking about it for several years, and significant amount of policy announcements have happened in the previous government and this government. Unfortunately, none of them have really attracted any amount of significant FDI in India. And I think that is more to do with the complexity that exists in the entire policy thought process. Brand-wise policies, category-wise policies, and now different ways of calculating the sourcing norms. I think it's just too complex for a simple trading business called retail. There was an opportunity, and that opportunity has to be taken up to how do we simplify this entire policy mechanism so that India, which is emerging to be one of the largest consumption markets, truly gets the right set of investments so that the retail can deliver to its potential over the next decade or so.
Okay. Good morning. Thanks for joining us, Rakesh. What is your view on how the relaxation of the 30% sourcing norms could impact not just the industry, you spoke about that, but also a company like yours? Rakesh, that question is for you.
Okay. So for us, it does not make an impact because whatever business that we try and do, even on a joint venture basis, we typically would look at manufacturing in India. What I believe is the fact that, without really doing manufacturing in a country like India, it is not going to be possible to really build a scalable business model. So while I think some companies which are very large in size, they need a lot more time before they can factor in a new way of doing supply chain management. They can really factor that in only if they are able to build the scale in India. And for them, I think it's a good start. So I would say, companies like IKEA or companies like H&M, which are both 100% FDI investments and both are large investments, they would definitely benefit from this. IKEA more because it has to really set up a large-scale fabric, furniture manufacturing facilities, etc. Quite a lot of that does not exist to a large extent in India. So while they will continue to source the linens, etc. from India, which is very good out of India, they get extra time to do the domestic sourcing. So I just hope the fact that, ultimately our objective should be sort of encourage manufacturing within the country. And maybe at the end of 5 years, that would happen, and that would really bring in the real benefits of FDI to the market. So it's a good way to start up. I think it's a reasonable concession. But I think the larger opportunity was to sort of, really look at, if you really look at almost all the policies about what foreign companies can do or not do, but there was an opportunity to sort of address the capital needs of the domestic companies, specifically in the so-called multi-brand space. Truly speaking, this brand definition has no meaning. Frankly, it's about really serving the customer's needs. And you will have multi-categories. It's not going to be possible for everybody to produce everything in a single brand. Several categories which are being consumed in India are not getting the right kind of opportunities to sort of grow their business. And that simplicity could have had help. I'm just still hopeful that over a period of time, government will have the wherewithals and have the learnings around what has happened in the last few years and come up with a more simpler policy which would actually make India truly an attractive FDI destination.
That's a fairly comprehensive backdrop that you're giving us, Rakesh. Let me invite Mr. Suresh of Arvind as well into this conversation. Suresh, both these rules, the single brand retail entry through the automatic route for 100% FDI, as well as the dilution or easing of the sourcing norm, how will it impact textiles?
Morning. See, I think I echo what Rakesh was mentioning. I think what it does is, I think it just eases the ease of doing business, and also in terms of sourcing norm, I think it will also encourage make in India for some of the global people. So as a fashion retail, I'm not expecting a huge amount of inflow of foreign exchange because of this change. Mainly because even otherwise the approval route was available, and it's a question of 3 to 4 months delay. You can always open a retail store. So I don't see a big impact in terms of the foreign exchange investment, and I think it's more complexity in terms of the retail policy, which has to be untangled if really the country has to attract international investment into retail.
Okay. Abneesh Roy also tracks this sector. He is with us on the panel. Abneesh, hi, good morning. You heard both the gentlemen from the corporate side. What's your own view on how the stocks would move? Because the sector as a whole is now trading at about 20 times FY20 EV to EBITDA. How is that placed, and what are your top picks here?
Yeah, we are quite positive on the entire space. We have seen sentiments improve. India has been rated as the best retail destination by independent study. We have seen in the past few quarters significant recovery in the same-store growth across most formats. If you see QSR, jewelry, fashion, and even food and grocery, even this quarter we expect most of the companies to clock strong growth, and it's an improvement versus earlier. Most companies should see close to a double-digit same-store growth. In terms of online also, because of government regulations and funding drying up, we have seen discounting come off, and physical retailers have also adapted to the situation. Future Group is rolling out Retail 3.0. Similarly, DMart is doing DMart Ready. Shoppers Stop is tied up with Amazon. So in terms of online also, clearly we are seeing the next phase of evolution and discounting coming down. We have seen online players set up physical stores. We have seen Myntra set up Lenskart. Similarly, Amazon has acquired globally and within India physical retailers some stake, and Alibaba in China also. So clearly, I think physical retailers have thrown to grow very strongly. And currently in India, if you see, less than 10% is the organized, and with the government.
Okay, Abneesh, we'll just get back to you. We'll reconnect. Anuj, you want to say something?
No, I was just wanting to ask a follow-up to Abneesh if we have the line back with him, because the issue here is that some of these stocks have future retail, for example, from 200 to 600, V-Mart, D-Mart, all these stocks have rallied a lot. So, Abneesh, the point here is how much of this is already in the price, or are we looking at a consistent 30-40% kind of CAGR over the next, you say, 10 or 12 years? Is that the market is pricing in right now?
The entire market, India and global markets are at a multi-year high, and retail companies have seen huge course correction, debt reduction, sale of non-core assets. So yes, retail stocks have done well. In terms of the profit growth, clearly it will be a very strong growth in the coming years. For most companies, we expect EBITDA growth of strong double digits across the board, and also debt levels have come down. So clearly earnings growth is something which will propel the next cycle. Re-rating may not happen, but clearly if you see Indian market is the highest growth market currently, and we are seeing sentiment improvement. So our topics currently clearly are Trent, Titan, Future Retail and Shoppers Stop, and we are also positive on the rest of the names. Yes, in some stocks valuation comfort is not there. For example, D-Mart, great story, but yeah, valuation comfort may not be there in some cases. But frankly speaking, we do expect significant upside in the next 1 year for most of these stocks.
Well, actually, the conversation was intended to be more about the RBI, the new policy of the government. But nevertheless, since it's taken this course, what's your sense, Rakesh? How have footfalls been? And is the story as cheerful as Abneesh is saying that there's a sizable improvement in demand in your stores?
No, I think Abneesh has been tracking the sector and he's sort of summarized it quite well. The markets have been buoyant. And I think the big difference is the fact that, organized retail is not a very old business in India. The companies have matured, the teams have matured. The execution standards that we are able to achieve are significantly higher. I think also, when you really look at, GST is for the first time enabled the real supply chain act that an organized retail must bring in, where we can bring in the scales to the benefit of the consumer. We can actually sort of promise onto the delivery without worrying about that where will we get it from, because in the past, taxation was a huge hindrance to create efficient supply chain. I think the real enablers to sort of take the benefit of an organized retail chain or organized distribution has really started with the implementation of GST. GST is just about settling in, and I think almost not only us, but I know for a fact that several of our partners who sort of help us supply goods, etc., are already looking at and in discussion with us in terms of how do we sort of improve the entire experience of the consumer at an organized retail store. And I also strongly believe the fact that when we are going to be able to implement that, we would actually see a significant amount of savings for the customers coming in our stores, and the entire experience would go up. And I think that is what the real enabler of an organized retail is. And that's got to happen in the next couple of years. So it's while we are a decade-old business, but the real work has started today. And I think the good times are still to come. The demand will be stronger, and we will ensure the fact that we bring in prices and products which convinces customers to come and shop with us.
20% CAGR, not an overestimation.
Not an overestimation, definitely.
All right, gentlemen, thanks a lot. I tell you something, it's been a win-win for everyone, for customers, for investors, for companies, this retail boom. Thanks a lot for joining us. At 10 a.m., the market is off the low point. The mid-cap index is once again flying. Just keep an eye on Jindal Steel and Power. It's a stock which is out of F&O ban. And after absorbing some initial selling, there's quite a bit of uptake that you're seeing on that stock, almost about to break into the green. It's been one of the strongest stocks. Ashwini Gujral and Rajat Bose now join us to tell us what are the trades at 10 a.m. Ashwini, looking quite okay on the mid-cap index, but a bit of a struggle for the Nifty and Bank Nifty. Your thoughts?
See, Bank Nifty was down almost 80. It's come off, 45 points from the lows, and hardly 4 banks are now in the negative. So like I expected that yesterday's low will get respected, and now possibly you have enough shorts on the Bank Nifty to drive it up. I think that way I would be long on Bank Nifty and expect that through the day financials pick up further, and Bank Nifty at least gets into the positive. Having said that, market is still range bound. There is very little use of saying that we are going to break out or break down. For the moment, it's deciding not to break down, and hence, after having tested the lower end of the range, a reasonable expectation is it will now go to the higher end of the range. Okay. As far as individual stocks are concerned, PC Jeweler is a buy with a stop of 535, target of 560. Dewan Housing is a buy with a stop of 613, target of 630. And Sonata Software is a buy with a stop of 280, target of 294.
Okay.
Well, there are a couple of things going for us as well. If you looked at the Asian markets, we are clearly the best performing market. Being flat, most other markets are down between 0.25% and 1.25%. As well, the other two macros, the rupee has fallen considerably. Now I think 63.80, so that's clearly a positive for several sectors. As well, of course, the bond yields have moved closer to 7.4 from 7.45 yesterday. So something's working well at this point in time. Rajat Bose, good morning to you. What would you trade now?
I have three long calls. First is United Breweries. It's actually showing a flag formation on end of day chart, bullish flag. I would put a stop loss at 11.32, or if you want it, you can actually put it at 11.35, and targets would be 11.64 and 11.75. That is also a possibility. And then second stock would be Just Dial. Disclosure has it that I hold some shares of this company in my investment portfolio. I would put a stop loss below 576, 599 and 610 are the two targets. And finally, at an IT story, that is Tech Mahindra, I would put a stop loss below 540, 557 and 561 are the two targets for Tech Mahindra. These three calls.
Okay, thanks for that. Well, Indiabulls Housing Finance is also surging now. So that stock is up 2.5%. Volumes are also picking up there. It's giving company to some of the IT names that are the big gainers this morning. Manisha Gupta joins in now with a roundup of all the commodity and the currency market action. Hi, Manisha.
Thank you for that, Sonia. Well, it's a positive opening when it comes to the crude oil prices. It's trading 0.25% up in the global markets, and we have seen good opening coming in for the crude oil prices in the Indian space as well. The overnight data has been positive. You have seen a draw in the U.S. inventories. There has been a decline in the U.S. production as well on a weekly basis, and that has been supportive. Add to that the fact that you have seen the U.S. dollar decline, so many of these dollar-denominated commodities actually are taking a lot of support from that as well. So support continues for the crude prices, holding quite well above 4,000 rupees per barrel on your screens. The gold and silver saw strength yesterday in the New York session, hasn't been able to hold it on right now. Yesterday, we did see the gold prices gain 0.5% to around those 13.22 kind of levels. It slipped at 13.17 in the global markets right now, and that's the reaction you are seeing for the gold prices on that as well. Though the prices are up 6% now for gold since the U.S. Fed interest rate hike in the month of December. And brokers and banks would tell you that much of the interest rate hikes for this year as well have been factored in, and there is a lot of supportive reports coming in favor of the precious metals. The base metal prices is yet another sector which has done extremely well in last year, and we are holding positive until now in 2018. There is some more buying coming in for this space as you are looking at positive data that has been coming in from China, whether it's the trade numbers, the retail sales, and of course the way the yuan has been behaving also has been supportive here. The markets are anticipating strong demand going forward. Many of these metals are in deficit, and that's making its way into prices. So you are looking at copper prices holding around those 4-year highs even now, and there is gains in iron ore and steel prices in Shanghai exchange today. That's the reason you are looking at steel ingredients as well trading in the positive. So whether it is zinc or nickel, we have seen strong gains coming in for that. Flat for nickel now, there has been a bit of a decline, 0.1% on the lower side. Trading strategies, and we have a couple of brokerages come out and give that for you. Starting with Angel, they have a buy call in gold. 29,520 is their target for today. There also are a couple of buy calls on the metal space from Grow Value. For copper, they're expecting 570 on the higher side today. They also have a buy on nickel where they're expecting 840 to be seen during the day.
Okay, thank you very much for that, Manisha. Well, mid-caps are actually now snaked up to a 0.5% gain.
Yeah.
So this is looking like not a flat market, but a good market for the bulls, especially in the mid-cap space.
Mid-caps really flying, and a lot of stocks are seeing short covering bounce. Canpin Homes, just pull out the intraday chart of that stock. It's seen some correction, and just look at that. And in fact, even the mid-cap index and the way some of these stocks are flying. So clearly there's quite a bit of buying which is returning to a lot of these stocks. The mid-cap index at the high point as we speak. But the Railway Board has revised the freight rates for transportation of coal and coke. That will be effective from January 15th. We have Sachin Bhanushali, Director and CFO of Gateway Rail Freight, now joining us. Good morning, Mr. Bhanushali. So the key question is, what do you think would have caused this hike? Is it increased demand or increased cost?
Yeah, good morning. if you go to the commodity basket which is carried by Indian Railways, over 40% of the cargo comprises of coal and coal related cargo, commodity basket. The overall cost structure of Indian Railways has always been under pressure because almost about 50% of its cost comprises of the staff cost. So there is continuous inflationary pressure on railways cost. In addition to that, the demand of the power sector, particularly for Indian coal, over a period of last 3-4 years has been robust because of change in policy. We earlier had the current railway minister looking after both energy as well as coal. Resulting into almost a drop of about 55 to 60% of imported coal, which was earlier being used for the powerhouses. Now he has the role of coal minister as well as the minister for railways. So there is a good amount of synergy which is arising out of this, resulting into the coal demand of all powerhouses being met by railways. The coal is such a commodity that transportation forms an important aspect of it. I think so. It's both cost pressure as well as higher demand, which has resulted into this revision. Railway will be able to cover a part of its inflationary pressure on its cost by this increase in rail freight for coke and coal.
Okay, I will come to what it means to freight companies in just a minute. But before that, are you expecting that now they may make it a generalized hike, the remaining 60% also? And if they hike, by what percentage?
The past history has been that the freight rate increase has come in, generally has come in piecemeal manner. So, and there has been no trend. So it will be very difficult to predict whether they are going to increase a general freight rate as well as the freight rate which is applicable to container train operators like us. Freight companies are normally doing the work of agency as far as transportation of coal and coke is concerned. They don't directly get involved into the freight. The freight service is provided essentially by Indian Railways. So I don't think this would have any significant impact on the freight companies. Freight companies generally get affected if the container rail haulage charges are revised or there is a change in the policy in terms of charging of access to terminals, etc.
Okay.
So I don't think this is going to have any significant impact.
Okay. But what is the average freight rate right now? The levels, where are they at? And in general, what kind of increment would you expect?
As far as the overall freight rate is concerned, those have been flat over a period of last 10 years or so. The overall increase has been of the order of about 72 to 75% as far as general freight rate is concerned. So that has more or less taken care only of the inflationary pressure on the freight rates. Going forward, I think a little bit of correction in terms of sectoral increase in freight rate like coal, coke, as well as the commodities for which there is demand can be anywhere between 5 to 7%, but I don't expect it to be across the board because the demand for many sectors is not yet showing up in good strength. So I don't think it is possible to predict a flat freight rate increase of a certain magnitude for all the sectors involved.
And what's your own market share in the sector now versus a couple of other companies like Concor, etc.?
So amongst the private operators, we are the leading operators. Gateway Rail Freight Limited, which operates its terminals at Faridabad, Gurgaon, Ludhiana and Ahmedabad, has a market share of 13% as of now. So the two dominant players in this would be roughly about almost about 85%. And the balance 17 operators take care of about 15%.
Okay. The next obvious question then, when are you coming out with an IPO? The market is good.
As of now, there is no plan of an IPO. The reason for that is that the company essentially is kind of on a self-sustain mode as far as cash requirement is concerned. So we're not thinking of an IPO at this stage.
Okay, you mean you don't need the money?
We have the money, I would say.
Right. Thank you very much, Sachin Bhanushali, for joining us with your take on this.
Thanks, Lata. Thank you so much.
Okay.
I sell batteries. Major Eveready Industries has forayed into the confectionery business as part of its diversification plan. They have entered the market through a brand, Jolly's Fruit Chew. So they will be launching a 1 rupee fruit chew very soon. Let's talk about that and the business. Amritanshu Khaitan, the MD of Eveready India, joins us now. Amritanshu, good morning. Over the last few years, you've branched out from just being a battery maker into a whole host of different products and now FMCG as well. Tell us about the plan here and how much do you think this could eventually contribute to the business?
Good morning, Sonia. You see, Eveready has been an over 100-year-old brand in the country, and the company itself is one of the oldest FMCG companies in India. And its mainstay business of batteries and flashlights was limiting the overall growth potential of this company, which leverages on two key assets, brand Eveready and one of the deepest distribution networks today in India, which reaches out to about 1 million outlets and deep rural. The first step the company took was to leverage on the brand, and we diversified into the lighting segment and into home appliances. This diversification has already yielded a revenue growth of about 400 crores in the last few years. And we now want to leverage on the other key asset of the company, which is distribution. The distribution network today basically sells batteries, flashlights, a bit of lighting products, and packet tea. So there's immense scope for the same Eveready vans which crisscross across the country to carry multiple products, much more than what we have today. And we can increase the lines per bill being sold into each retail store. The first step was packet tea. But packet tea being a very mature category, we got limited success without brand investment. So we are spinning that off into a separate entity and getting McLeod Russell to invest into that entity to grow that category. Okay. Confectionery is another logical category for us because it provides a mass market product. It's at a price point of 1 rupee. About 30% of the category is unorganized. So companies like Eveready, which reach down deep rural, offers consumers better quality products and a choice to upgrade from a poor quality unorganized product to a branded product. And that's how the whole rationale came in, that this is the first step of getting into confectionery, and we would want to add more products going down the line in the next couple of years.
Okay. Good morning, Amritanshu, and thank you for joining us. A great 2018 to you. Well, this is I completely take the synergies that you will get because you'll have such a good distribution system. But confectioneries is a huge and extremely competitive industry, where there will be very nuanced understanding of tastes. So, you know, you're up against the Nestle's, the Cadbury's, and a whole host of unbranded, even the guys like Parle's would be over there. What kind of margins can you make when you're up against so much competition?
Lata, our experience with the lighting category has said that when you hire good talent from the industry which you are entering, they bring in all the expertise required to make it successful. Similarly, on the confectionery side, we have created an in-house team which have been hired from the industry of confectionery to develop new products which can come in to be sold. The distribution cost is zero. So for a confectionery product, for other companies, it is about 15% of sales which goes into cost of distribution. For Eveready, it is at a zero cost. So that gives us competitive advantage. Okay. And we selected the fruit chew segment, which is a new segment growing very rapidly, not very visible and present across the country. So our first foray is into a category which is less cluttered. You only have 2-3 brands, out of which one brand is regional, based out of Maharashtra. Which provides us an opportunity to first establish, and then we will see how we can grow.
Okay. Will you, in terms of, Amritanshu, good morning. In terms of advertising costs, how much have you budgeted for? Because, again, you know, it's a very competitive space and you have a lot of advertisements of these kind of products. So, if you could give some information on that.
You see, this category comes with high gross margins and low entry barriers. So we are working on a very asset-light model. The product is completely outsourced, though it is being developed by us. So it allows us to spend about 15 to 20% of the turnover this category will generate in the first year for advertisement. So we estimate that in FY19, which is a coming year, and then if you look at just 1 year ahead, if you take FY20, confectionery should add about 150 odd crores of revenue. And we plan to invest about 20 to 30 crores behind the Jolly's brand in terms of advertisement in the next 2 years.
Which is the biggest, I mean, in this brand, there is Mango Bite, Hajmola, Pan Pasand, Pulse. Which is the biggest brand? What are you up against?
We have entered the jelly segment, which is called the fruit chew segment. And in the fruit chew segment, the revenue growth, the revenue is about 400 crores, with the market leader being Alpenable, which has a brand called Just Jelly. You have a regional brand in Maharashtra called Falero from Mapro and Candyman from ITC. These are the three big players.
Okay, Amritanshu, all the best. You've gotten us hungry now, so we're going to wrap up with this conversation and go and try and find some food. But all the best for your new venture and, of course, growing the business forward. That's Everready branching out substantially, right?
Oh, yes. Interesting.
Interesting. Very interesting.
Very interesting. By the way, the market is actually in fine fettle now. The mid-cap index is at the high point of the day, and advanced decline clearly favoring advances at this point in time. So a lot of stock ideas for you coming up on our next show, Chartbusters.